Hey, how are you out there today? This is Matt Heisler, back from a brief hiatus, back to the YouTube channel. And there was just some news yesterday, and I had some time on my hands, so wanted to address it. Trump came out and said that one of the ways that we could solve the housing crisis was to push for 50-year mortgages. And there was a lot of pushback to that. And so I figured I'd just take a brief minute, try to use some real numbers and just sort of explain to people why 50-year mortgages is a bad idea. Now, having worked with lots of buyers and sellers, I know that when you're shopping for a mortgage, primarily what people are looking at is the payment. And what allows them to look at the payment is the fact that most mortgages are pretty similar in terms of term, 30 years. And so what you're really trying to do is you're trying to get the best interest rate for that term. And then that makes things pretty simple because now you can figure out what the payment is and all that. But if you're going to start changing how long the mortgages last, then you have to start looking at a few more things to really understand what you're doing. So in order to do that, I'm going to just take a brief example here, and I'm going to say that, that you're going out there and you're going to borrow $500,000 and you're going to get a typical 30-year loan at 6%. Pretty simple, right? So the way that that works today is that, you would probably be paying off initially in the beginning around $6,000 in principal, okay, for the first few years. It goes up, relatively steadily. It goes up about $500 a year. So, by the time you're into the 10th year, you're paying almost $10,000 a year in principal on that payment of $3,000 a month. It's a little less than $3,000 a month, but we're going to round. Pretty simple there. Your payment is $3,000 a month. But in the beginning, you're paying a pretty significant amount of principal. Over the course of that loan, if you don't refinance or anything else, but if you just pay it every month for 30 years, you'll have paid in this scenario about $579,000 in interest, which is a lot. I mean, it's more than you borrowed, right? Remember, we borrowed in this $500,000. So you're actually going to pay more than $500,000 in interest. And that is really the key. If we take the same loan and we move it to 50 years, one of the things that happens is our payment gets cheaper. It doesn't get a lot cheaper, but it does get cheaper. It gets down to $2,600 and change. So you save about $350 by stretching out that mortgage to 50 years. The problem is, instead of paying $6,000 in your first year, which is very much off the principal, your first year you're only going to pay 1,600. Okay, so you're going to reduce the amount of principal that you're paying off by almost 75%. Okay, which is just terrible, terrible, terrible for the consumer. And if you're like, well, I mean, how much worse can it be? Well, you're going to end up paying over $1 million in interest over this loan. So not only is it going to take you 20 years longer to pay it down, you're going to pay twice as much in interest. So this idea that you can just stretch out the term is and have that be a good idea. And the only thing it's good for is reducing the payment a few $100s a year. I mean, $300, it makes a difference for a mortgage payment. Like I get that. I would like to pay $300 less. I think most people would. But at the end of the day, it's only $3,600 a year. And in exchange, you're giving up 20 additional years on that mortgage and another $500,000 in interest payments. So, from a consumer perspective, the biggest problem is we don't live long enough for a 50-year mortgage to make sense for us. Okay. You need to be able to pay it down. And the 30-year mortgage, I would argue, is actually a little bit too long in and of itself. But the economy is growing, and so it's good. Like, I'd actually like to see them bring the top term down to about 25 years. Why? For the exact same reason that the 50-year doesn't work. You're going to be paying more principal earlier. Okay, you're going to be able to pay it down faster. You're going to be able to build equity faster. And the whole point of home ownership is to build equity faster. And I know you're going to say to me, well, Matt, if it was 25 years, doesn't that mean that the payment would be higher? Yes, that's what it means. It means that the payment would be higher. But if everybody was getting a 25-year mortgage, and again, this isn't going to happen, but in my dream world, it would be great if it did. If everyone was restricted to just buying a 25-year mortgage, everyone's payments would go up. And believe it or not, that means that the price of housing would have to come in a little. And so at the end of the day, there would still be this balance between what people can borrow and what people pay for housing. So that's how it works. The more money you can borrow, okay, either because of lower interest rates or because you have more income, the more expensive housing gets. And that's what happened during the pandemic. Interest rates went really low, house prices went really high. That's what happens when interest rates go really low. And so now that interest rates have come back up and they're much less attractive, the housing market is starting to revert to a more normal pattern of price increases, which is much slower than what we saw over the pandemic. So I just don't want anyone to think out there that, when it comes to mortgage, the only thing that matters is payment. It's not true. Term really matters. And ultimately, what really matters is the total amount of interest that you're paying over that loan and how quickly you're building equity. So a 50-year mortgage for almost everyone in the retail space, for people who are just looking for a place to live, is a terrible, terrible idea. And if it's something that you think that makes sense, I really encourage you to pull up a mortgage calculator with a full amortization schedule and take a look at what that looks like. If this video is popular, who knows? Maybe I'll do another one on loan amortization because it turns out there's another solution to actually making mortgages more affordable. And people won't like this either, and it's also never going to happen. But if people want to know, I'll do another video on it. Thanks very much. Matt Heisler, Vanderbilt Properties. See you next time.